right, recording is live. Let's get into the free live stream channel on the Discord. Duh, can't talk right today. We're going to do some fib retracement discussion. We'll call it a pop-up. Why not? We'll call it a pop-up lesson. And hopefully people will watch it. It will blow their minds. Just kidding. And maybe we'll learn something about Fibonacci retracements, because this is one of the most commonly misunderstood topics when it comes to the stock market, and it's so easy to fix. So let me share my video in the Discord. So hopefully they can hear me, they can see me, they can maybe smell me. I don't know. Hopefully not. Let's see who we got. What up, Jay? Hey, nobody. Just waiting for Belmont and a couple others to show up. I just want to give you guys a little bit of a just a free nugget of education here. I think you'll like it. It's actually one of my favorite topics. I just want to make sure everyone understands what retracements are and kind of how they matter. So people are pouring in as I speak, so we'll just go ahead and wait a little bit. Give everyone a couple minutes. For those that are here, are you able to hear me? Let me write that in the chat. Are you able to hear me? Let's do that. Then I know if I have to reset. I hope so. I'm looking forward to this one. It's going to be a fun one. I say that because I'm a nerd. But we'll get you there. Okay, let me get that. Guess I should open up my notepad. All right. I guess let me pop this up on my. Can you hear me? I don't think anyone can hear me in the Discord. There might be a little bit of a technical issue. Yeah, okay, so we're having some people kind of come and go. Let me restart. All right, so I'm going to restart the Discord. I'll be here in the live stream for those who are on social media. Give me ones. Oh, you guys are just messing with my emotions. They can hear me. Well played, guys. Well played. All right. So, thank you for letting me know that you could hear me. I appreciate it. I'm just rambling to myself. All right. Okay. So let me just, we'll do a fresh start here. We'll be nice and clean. Like I can't answer that. I can't follow up on that. We're going to be nice and clean. So basically, what is a retracement? First, let me make sure Belmont's here. Is Belmont here? Belmont's here. Okay. So if you think about the market in terms of push and pull, right? Those are displacements. Let me draw some blocks here and we'll kind of visualize that. Ignore all the candles. We're not going to look at the candles right now. So let me just scroll over here. We've got supply and demand, right? Just basic concepts. You have money. I have something you want. You're going to pay me money. I'm going to give you the thing that you want. And then I'll take that money and I'll go do the same to someone else, right? That's just basic exchange of supply and demand. So up here, in terms of the chart, you've got price on one axis and time on the other axis. Price action is just a function of price over time, right? You're just tracking the amounts of moves between the prices over time. So up here at the top, you've got supply. You've got think about it in terms of supply and demand. Pretend that pretend what I'm saying is accurate. It's really not, and the lifetime members kind of know a little bit more. But just pretend up here is a bunch of people that have shares and they want cash, and down here is people that have cash and they want shares, right? That's not actually how it works, and I'll explain that on a different stream at a different time, but that's to conceptualize the stuff, just accept that. Okay, so, and then kind of what you've got between those two levels is a displacement, right? So this gap right here is a distribution gap, okay? Let me just change that to like a dark blue. Right. And this is just kind of, think of it like where the transactions happen, right? You've got the orders that are matched and it's marching the price up, it's marching the price down until it finds these areas of equilibrium, and that's cool. So that's kind of the move that we like to look for in the market. And you'll see that mostly with support and resistance traders and things like that. So in order to get from consolidation areas, right, where the price just kind of sits sideways or doesn't really go anywhere, like a resting area, to the next resting area, it has to displace, it has to move, okay? And in order to do that, you need some sort of impulse. You need something to overpower the mid price so that the price can actually move up or down, right? Otherwise, you're just matching one for one, and the price doesn't go anywhere, okay? So that's just generally how the market works, right? If people buy a bunch of gas prices go up, right? For example, if people stop buying gas prices go down. Slightly different example there, but just absorb the concept that price goes up and down because of people participating at certain levels, okay? So what we can do is we can identify these impulses to and fro, okay? Price goes up sharply, price goes down sharply. Up here, maybe you've got in an alternate universe, right? Maybe the price isn't going up or down over this period of time. Maybe it's doing one of these numbers, right? Maybe it's channeling instead, okay? What we don't want to use a fib for is that, okay? It can be up here, it could be down here, it doesn't matter. What we're interested in mostly is when the price goes from here to there, okay? And then what that does is it introduces an interesting concept that we can exploit, okay? And that is volatility. And volatility also exists down here. It's just very small. It's lower volatility. Then you've got higher volatility when things expand. And when things expand, that gives us the opportunity to trade the retracement, okay? So let me kind of get to the point now that enough people are here. I kind of filled a little bit because a lot of people are still kind of coming and going. So basically, let me just move up here. I guess that's probably better than trying to go off to the side. So let's say we've got an impulse to the upside, right? Everybody knows what this is. You've just got a series of candles or a series of price moves from one level to the next, okay? And then eventually this has to stop, okay? It doesn't necessarily mean that it's gonna, it's due for a pullback or that it's guaranteed to stop at any specific level. We don't control that. We don't predict it. It just happens and we allow it to happen. But eventually it will stop whenever the chart determines it's time for it to stop. And the chart is always going to be right. And then since it's stopped, it can no longer go up, right? So that's to say it can't pull back and go higher or plateau and then go higher. But this continued move to the upside, at some point when the chart determines it's time to stop, it's going to stop. And at that point, something like this will happen, right? It's going to be something else other than continuing from that exact point to that exact point. Otherwise, it's just, the impulse isn't over, right? Just logically speaking. So at some point, this has to stop, okay? And after that stops and we see maybe a little pullback, that's when we know that's a pivot, okay? That's when we know that the impulse has formally stopped so we can start to measure the move backwards, okay? And that's the retrace. So if you think about it in terms of you starting here in a cabin in the woods in the wintertime, and I always like to use this example because it seems to resonate really well with people. This is your cabin, and you just start walking out in the woods in some direction. You're just going in a straight line for as long as you can, right? And then eventually you start to get tired, or maybe you just get hungry and you want to come back, but you decide to retrace your steps and go back to the cabin, okay? So that's all you're doing when you measure a retracement. You're just measuring the strength of that pullback or the health of the pullback by measuring its distance, okay? How far back to the cabin did you make it? And I actually, you know what? Let's throw that analogy out. Let's use the older one that I like to use. You're climbing a mountain, right? You got a bunch of different people down here at the base of the mountain, and everybody wants to climb to the top. So you get up to, somewhere up the mountain, and you decide, okay, this is far enough. I need to come back down the mountain. Maybe you run out of oxygen. Maybe you got hungry. Maybe you have to go to the bathroom, right? And you just don't want to be rude. So, maybe you twist your ankle, right? So you start coming back down the mountain. The people that don't stop very long and they don't rest, they're likely to push higher and exhaust faster and then come back down faster and harder, right? Because they're going to have more problems because they didn't properly rest. Does that concept make sense? I'm just going to replace this tool here with a polyline, but it's the same concept here. So just kind of bear with my drawing here. I'm not the Bob Ross that I once was. All right. So when you get a shorter pullback like this, okay, there's still a lot of strength to the upside, which means there's a lot of, there's a high likelihood that it'll push to a new high. But because there's fewer people here that have participated in this pullback, all the other ones down here that bought and want to take profit, they're just going to pile on later. And then the stock market, that's what's happening. And that's usually what you get when you see this. When you get a super shallow pullback, you tend to get a new high and then a harder sell-off. Okay, so in terms of climbing a mountain, these are just people that didn't actually take their chance to rest. They just wanted to push, go to the peak, and then they crash even harder and they have to come back down that mountain sooner, right? Now, the other scenario here is you get a healthier retrace, which means the price comes back down about halfway, and we'll get into the specifics of the retrace tool here in a minute. But that's basically the best possible scenario because these people are getting enough rest, but they're not so far down the mountain that they have to try that much harder to get back up. So they tend to go a little bit higher for a little bit longer. And that's how you can typically develop things like uptrends with higher lows and climb to the next mountain, and so on and so forth. Okay. And then the third type, and again, I'm only interested in measuring this little pullback here. That's all we're doing. I don't really care too much about what happens afterward. And then you get the third group of people that just comes too far back down the mountain. They get discouraged. Maybe they're injured. Maybe they've just walked this entire distance and this entire distance, and they just don't want to go back up the mountain. The car's right there. The cabin with all the liquors there, the coffee and the hot cocoa and all their friends and the snow bunnies or whatever. It's all there in the cabin. They just don't want to go back up the mountain, and they don't, right? Maybe they just don't want to resupply and all that good stuff. So it becomes that much harder for these people or for this price to climb back up the mountain. Okay. So at this point, you're probably just not getting up that mountain, right? So in a lot of cases, a deeper retrace means there's less likelihood, but not an impossibility of forming a new high, right? Reaching a new peak, if you will. Okay. So if you think about it, right? Again, if we're starting here and we're pushing up this mountain, this is our impulse. This is our initial leg where we're the most motivated. We're the best prepared. This is our best possible shot of getting to the top of the mountain, but we have to rest. Then we're going to measure this retrace here. How far down the mountain did we come? Is it too far? Is it not far enough? Is it just the right amount? And that's where we figure out the likelihood of reaching a price target. Does this make sense so far? If it does, put a 1 in the chat. If it doesn't, put a 2 in the chat and kind of let me know which part I've lost you on because I kind of mixed analogies there. All right, Belmont says 1 with an exclamation point. We like that. So good, strong, confident 1. Now I'm going to talk about the tool afterwards. So if enough people say 1, I'll move on to the tool. If anybody says 2, I'll clarify whatever might be getting in the way, and then we can go from there. Got another 1 in the chat. Death gun. Okay, you said 2, and that's good, right? There's no wrong answers. What part is confusing so far? Because this gives me a good opportunity to explain things better. So this is feedback I need. I have to become a better teacher. And it starts with Dr. Pepper. Stream is not sponsored, but if the Dr. Pepper CEO is in the chat, hit 3 and we'll go from there. I want to work out an endorsement. It's for your benefit, buddy, not mine. All right, Sybil says 1. All right, good stuff. I see we got some OGs as well. We got Tammy in here. We got Arch Knight. Wow, Arch Knight, buddy. How have you been? Brutal Trade. Good stuff. NG, Mikey V. And our good friend Shin. Shin, I was just talking about you yesterday. It's good, though. Okay, Death Gun says, I may have missed it. How does the retracement signal the new highs or lack of said new highs? So right now, we're really just focused on measuring the pullback at this point, right? So we just need to figure out, is it a shallow pullback, a healthy pullback, or a deep pullback, right? And from there, there's just statistical likelihoods of either getting a faster new high and then a harder sell-off for a shallow pullback, a healthier and typically prolonged new high or series of new highs, for a healthy pullback. And then there's the lower likelihood of a new high when there's a deep retrace. So the retracement itself, we're just measuring that. So you're just a measuring tool. That's all the fib retracement is. Okay. You got it? Was that the only point that was confusing you? Okay, cool. Perfect. So with this information, right? And I'm sorry if let me just check the camera here because I don't want to cover up I have my camera on the stuff. So if you guys can't see stuff at any point, just let me know. I try to be cognizant of it, but sometimes I just mess up. So I'll try to keep it over here. So we've got an impulse, right? And on previous streams, we've covered how to manually identify or mechanically identify an impulse. So for the quick and dirty here, this is just view it as a pivot to pivot, just a continuation of candles. Or specifically, you can also use multiple candles in a row, either to the downside with lower highs or to the upside with higher lows, like right here, for example. Every candle from here to here has a higher low, and then that series is broken right here. So the highest point here would be the high, so that'd be a low to high. And if we just look at this in isolation, there we go, just this impulse here, you can see that we start measuring the pullback, right? And we hit our healthy zone, our 50 to 61.8% zone. And then we can look for a low risk opportunity for a break out of that zone. Let's see if we get that. In this case, we do not. Therefore, no trade, right? So I'll cover that here in a second. But it's also a counter trend, right? This is obviously a very strong push to the downside. So we wouldn't really be looking for an upside trade. So if I come back up here, there we go. Sorry about that. All right, so we're back to where we started. So we've got these levels here that we can use to measure this pullback, right? Now, all we need to do is measure the pullback, classify it, and then we can do things like expand to potential targets. We can look for low risk opportunities in certain areas to trade different types of trade. There's all kinds of stuff we can do. So in order to just draw the tool, okay, we got to go up here. If you're on Webull, if you're on the app, it's going to be in the top here. You're going to have a bar. The first one here is the indicators. The second one here is the drawing. So make sure you click the pencil, and then you're going to go here to the second drop down. So the first one is all single line tools. So it's just line segments or lines. Okay, that's all it is. The second one here is your multiple line drawings. So 2 clicks, 3 clicks, whatever it takes. The third one here is fibs. It's all fibs. So we're going to use this one for this specific thing. And then there's the text tool and notes and stuff like that. So what I'm going to do is I'm going to click this fib retracement drop down here. And for just the measuring, I'm going to use the fib retracement. I'll cover the extension in a little bit. We're not going to care about time zones. That's kind of it's a little bit gimmicky. But for just drawing a tool, you're going to click the fib retracement tool. Then you're going to come down here to your low. And then you're going to draw a line up here to the high. Okay. Because again, in the spirit of retracing, right, or measuring a pullback, you need to draw in the direction of the impulse, because the magnitude of the pullback is proportional to the impulse itself. Okay. So if you push all the way from down here to up to here as the impulse, your pullback is going to increase on the way down, right? So if you retrace 11.8% of your steps, for example, you wouldn't be down here. Okay, that's a much bigger amount of steps that you've retraced. So if you walk a mile and then you walk back a quarter mile, that's a 25% retrace. Does that make sense? You walk a mile and then you walk back half a mile. That's half of a retrace. It's 50%. Okay. So just go ahead and slap 1 in the chat if it does make sense, and a 2 in the chat if it doesn't, and then I'll know to move forward. But I don't want anyone to be confused about this stuff. So the fib retracement tool itself requires 2 clicks, 1 at the low, 1 at the high if you're measuring an upward impulse, a bullish impulse, high to low for a bearish impulse. Okay, so just draw it in the direction of the impulse, and then you can use it as a measuring tool for the pullback. Okay, I got a bunch of 1s in the chat. Beautiful. So let's keep moving. So now we've got an area here, and again, you can't draw this until after the impulse stops. So don't feel like you have to try to time the top or the bottom. You're waiting until the top happens, okay, for an uptrend or for a bullish impulse. Now we measure, okay? So I like to draw the 25% fib retrace and the 50 and the 61.8. There's a lot of different concepts and a lot of different strategies out there that use different numbers. Ultimately, it doesn't really matter too much. Even if you draw the fibs backwards, it doesn't really matter too much, okay? You're really just looking for statistics here. And this is, again, there's never a guarantee, which is why we don't want to master any one strategy and pretend it's going to be winning all the time. The goal is not to avoid losses. It's to embrace them and control them, okay? So what we do with this is we're measuring a pullback for probability, okay? And then we're capitalizing on that probability by taking a low risk entry opportunity when it presents itself, okay? And again, once we're in a trade, our goal is to get out of the trade. So don't feel like you have to hold something the entire time just because a fib tool says so. These are just likelihoods. It's just statistics. It's not something that's going to happen on that exact time that you're in there, okay? So typically we see a 25% pullback about 90% of the time. So that's my personal favorite because I just like those consistent base hits. Earlier in the free Discord, let me put that link in the chat here on social medias as well. If you are not in our Discord, feel free to jump in there. It's 100% free to join. Foundation's always free. But I did a pretty in-depth discussion about standard deviations and Bollinger Bands. So that's a perfect opportunity to use something like that with a 25% pullback. About 60% of the time, we get a 50% retrace. About 40% of the time, we get a 61.8% retrace. So we really want the price to come back here between the 50 to 61.8%. And the mistake a lot of fib traders make is that they buy it as soon as it enters this zone instead of waiting for it to leave the zone. Because again, you want the price to be going in the direction it's going to make you money when you enter it. You don't want to just jump in because it's pulling down, right? And I hate seeing people do that. And I hate seeing people beat themselves up because they eventually figure out that it's not working and they blame themselves because they should have known better. And you don't do that to yourself. We cover psychology a lot. But basically, this is like an ideal setup. Okay, we look for price to have an impulse, price to have a reversion, and then that to be a healthy mix of sell-off and buying in, and then for that to result in continuation to the upside into a higher high. Okay, so if that makes sense so far, we can cover the next step, which is going to be the fib extension tool, which is how you can kind of project a target, right? And again, our job is not to predict. I'm just showing you how to use a tool. I personally don't use the extensions. I know a lot of traders that do, and they do well, but it's just not for me. Okay, so the extension tool requires another click. Okay, and that's going to be a third click. So you draw it from the bottom to the top, just like you do for the regular retracement tool. And then this third click comes down here to the bottom of the pullback. So again, this doesn't become the bottom until it becomes a bottom. All right, so you can't predict this. Like as this line is forming, this is going to get lower and lower and lower until eventually it's not, right? And at that point, that's when you draw that fib extension tool. All right. And then what you can do is you can take this. I'm going to draw both tools so you can see them side by side. Okay. So now we've got our fib retracement tool and we've got our extension tool kind of off to the side here. Let me change that to a yellow color so we can see the difference. Now, if this is retracing into the 50 to 61.8% range, okay, then the extension tool tells me that the likelihood of this reaching the 50 to 61.8% target as an extension should be pretty high, right? So the price should move from here to here, in theory, okay? And that's all it is. That's all fibs are. Now, if you notice, if it pulls down, let's say we've got a 70% retrace, you know, those numbers come down as well, right? So watch that 50 to 61.8, this block right here, okay? This comes down. Let's say we get a 78.6% retrace, which is around here. See where that 78.6% is on the extension? It's about the same damn level, right? So it doesn't matter. So I see a lot of people get confused by that as well. Basically, if you're just looking for fibs, you can usually target just under the new high or just under the old high, and you'll get consistent base hits a lot of the times, as long as you wait for that confirmation. Now, I can't give you guys financial advice, and there's always a disclaimer and all that good stuff. So I don't want anyone to copy this strategy or any strategy blindly. I want you guys to scrutinize the hell out of it because you are seeing it on the internet from someone you don't know, even if you've been with us. It's not my money that you're going to be trading with. So, and this is something you're not going to hear from other YouTubers. Scrutinize it. I encourage scrutiny. Pick it apart, collect the data, prove to yourself that it works or doesn't work. It's entirely your journey. So don't blindly trust me or anybody else. Okay. Just understand that the concepts are something you can understand, hopefully. If not, then I can work on that. And ask yourself if those concepts make sense. And then collect data, right? Your job is to collect data about yourself as well as the charts and the strategies and stuff. Don't strategy hop or any of that stuff. That's just a waste of time. Your best course of action as a new trader is, number one, slow the hell down. Your job should be to protect as much money as you can, in my opinion. Don't come after me, SEC or feds or whoever. I'm not giving financial advice here. But I see a lot of people take themselves out of the market by just rushing into stuff hoping to make a profit. So figure out if that aligns with your goal of making money in the market. And the second part is going to be to study yourself so that you can figure out what's preventing you from doing what you know you should do. Because you are a human, and that means you're an organism, and you have a brain that was developed in a certain way, and it was optimized for survival outside the market. And the market was designed to exploit that. So you got to slow down, and you got to figure out what makes you tick and how you can protect yourself and your money. So we focus a lot on psychology. That's like my bread and butter. We get into neuropsych stuff. We talk about the anterior cingulate cortex and the amygdala and all that good stuff, but I'm not going to get into all that right now. This is just for fibs. But let me catch up on the chat as well. Because I do ramble a lot too, and I will so get off topic really fast. Tammy knows, she's been here a lot. Death Gun knows too. Best explanation for newbies like me. Well, newbie, your name is literally newbie, so I'm glad to hear you say that. That's awesome. If fibs resonate well with you, use your fibs. If Bollinger Bands and standard deviations resonate with you, use that. If you just want horizontal lines, let's say, and this is my little parlor trick that I like to do all the time. If your goal is to just pick one price point, just a random price point, and you want to just trade it when it goes over that level, and you want to keep your risk nice and tight every single time it does, you can be profitable doing that. As long as you can do it consistently and you're buying when it makes sense, it's pretty fun, right? The problem is that if your plan is to buy when the price goes over here and to cut it when it comes back here and take profit when it's up here, and you're still in it down here, you have deviated. And that's because you're don't take this the wrong way, but your lizard brain that was optimized for survival doesn't allow you to respect this line right here. And this is the most important one. Okay. So your job is to figure out why that happens and to protect yourself. And that answer is going to be different for everybody. Okay. We all have the same structure in our brain, but there's different parameters and different configurations. And it's up to you to read the manual and figure out what kind of features and troubleshoot it, you know? But I'm glad you're here so we can start the conversation. Sybil says, sorry, can you redo the fib extension drawings? Yeah, my bad. So hopefully, is your internet okay now? I'll just redraw it really fast. Okay, cool. It is. All right. So I'm going to draw the fibs first just so you can see that. So again, we draw it in the direction of the impulse. And then for the extensions, right, just go here and click fib extensions. You go in that same direction again. So 1 click, 2 clicks, just like you do for the fibs. And then a third click down here after this bottom forms, right? And then that allows you to draw your extension tool. Okay. Oh, I drew that in the wrong spot. My bad. Again, I'm not Bob Ross. Happy little accident time. Okay. Well, that should be down here, I guess. You know what? I quit. I quit art school. We're going to have an incident. I'm just kidding. All right. So that is more closely aligned. Okay. So let me catch up on the chat. Yeah, it's just that third extra click is just the bottom of the pullback. That's all it is. Arch Knight, does this fib work on any time frame or should generally be used on a certain time frame? No. It's all relative to the impulse. So any impulse you see, okay? Big or small, it's going to have a retrace eventually, and all you're doing is measuring the depth of that retrace. That's all. It can be a 2-cent impulse if you really break it down into a microscopic thing. Obviously, the bigger the impulse and the healthier the retrace, the better your probability will be. But you still have to find a super small risk in that post pivot critical era, if that makes sense. All right. So for those who are curious, just a super cheap and easy. You know what? Let me just come down here. Anyone who's curious, just for a stupidly simple strategy for confirmations. One that I personally like to do, just focus on these 2 candles right here. Ignore all these over here to the left. Anytime I see a small red candle, like you see this and that, the top of the candle body, the opening price of that red candle is my entry threshold in a lot of cases. So after this candle closes, then I know that it's worth watching. If it's still forming, it doesn't matter. But the lower of these 2 participating candles is the stop loss in my case. And then I like to just buy it when it breaks over that entry threshold and then set that stop nice and tight. So the smaller that range can be, the better. But that's basically the very simple pattern that I like. And I like to look at that in an area of high potential, such as a fib retrace. So just right here, just getting off of that pivot, right? Just coming out of that box. That's where I'd like to see that 2-candle pattern, okay? It's just a very simple color change. It's nothing crazy. And the main advantage to that is that the risk is stupidly small, right? If you can lose less than 1% overall on a trade, you can do that a whole bunch of times and still survive. And if your profits are disproportionately larger than that, you'll have a good time in the market overall in most cases. Even if you end up taking a bunch of small losses, that does happen. That could be just a timing issue as well. Maybe it's the quality of the stuff that you're trying to trade. There's any number of reasons, but any trader who can endure a bunch of small losses automatically has a huge advantage over the 90% of other traders that fail, because losses are what take people out of the market. And that trader has made it a point to prioritize minimizing them as much as possible. Okay. So sorry, let me catch up on the chat. Oh, Sybil, yes, it is. Got it. Awesome. Okay. Arch Knight, thank you. Oh, I'm doing the same hand thing right now. I don't know if you can see that. Weird. Belmont, very understandable explanation, mate. Finally have a decent understanding how fibs work. Good stuff. That's great. So I'm glad you guys asked the questions and were able to participate. This is also recorded, so I'll make sure that you guys get a copy. Okay. There is one specific thing that I want you guys to do, though. Okay. First, I'm gonna put some links in the chat for you. If you haven't done them yet, check them out. There's obviously no commitment. I'm not going to do a big sales pitch or anything, but there are some things that I want you guys to take advantage of. Okay. So the first one, do yourself a favor. That link right there, I'll put it in the social media chat as well for anyone who's watching on either Twitch, Kick, or YouTube. This is just full transparency here. It's a lead collect lander, in that we just collect your emails so that we can send you reminder emails and things like that. And that is for Lee's live stream every Thursday morning. So if you missed the one this morning, we'll send you emails to keep it in front of you so that you don't forget, because that stream is one of the best streams you can attend, in my opinion. He's got an accent that I don't have. So make sure you guys go to that one. And if you're comfortable giving us an email or throwaway email, whatever, that'll at least make sure that you don't miss out on that Thursday stream. Okay. So with that said, now the next link I'm going to give you is also 100% free, and I'll put that on the social medias as well. That is for a 5-day free trial of Premium. So don't feel like you have to rush into it. It's a one-time use thing, and it just gives you 5 full days of access to our Premium subscription. Now, the only thing that you don't get access to, let me rewind here. So part of Premium is getting a coach. Okay. So as a trial member, you don't get a coach assigned to you. Like, you don't have the access to the channel where you chat and engage and stuff, or the recorded written education. You do have access to the live stream for that week for each of the 2 coaches. But you're kind of like a little ghost. And that's only so that we don't disrupt the people that are currently paying. Right. So it's kind of we'll give it to you, but we can't have any disruptions. So you can watch the streams. Okay. So I want you guys to definitely show up to that. And again, that's a 5-day free trial. So you get the whole week, you get all the other Premium stuff, you get all the other alert channels and all that good stuff. But that's the second item that I want you guys to take advantage of. Both are 100% free. And then the last one here, again, full disclosure, not free, but it's not out of reach for a lot of people. This is the link to Lee's coaching program, is Mad Maverick. And again, there's no sales pressure. I'm not a sales guy. I'm just putting it in front of you in case you think you might lose $40 or more next month, within the next month. Maybe it's worth getting a coach that can walk you through building a trading plan, and he gives you all his alerts and his walkthroughs and stuff like that. That kind of builds on what he shares on Thursdays. Okay, so if you like this stuff, that's right up your alley. I think you guys will like that. But again, there's no pressure. It's there when you're ready. And I'm not going to do a bunch of sales links or anything like that. I do have like indicators. We got the premium streams, premium subscription stuff. We got lifetime. I'm the lifetime coach, so I teach those guys a little bit more. Sometimes I hurt their brains, and I'm sorry for that, but you guys get unfiltered, unmedicated Pookie. And we go pretty hard in the paint on a lot of stuff there. What did we do? Was it fractional reserve banking? And then what was the last thing we just went through? Tammy, help. What did we do? It was complicated for you guys. I'm just kidding. What was it? Let me just go look in the channel real quick. That's going to bother me now. It was, just completely lost track of what I was. We did fractional reserve banking. We talked a lot about the heat and rhabdomyolysis. Credit. We did the credit cards and stuff. We walked through like what FICO scores were, kind of how we can leverage the credit system. Now, who here is under the impression that you need to maintain a lot of debt in order to build credit? Like you know, the old saying about using 30% of your credit limit, right? Who here believes you need to use the 30%? And do you guys know what the FICO score is made of? Like, I won't go down that rabbit hole, but there's a huge amount of the population that believes that because you have a credit limit, you need to use 30% of it in order to build credit. In reality, I'll tell you guys something you're not going to hear from your banker or from a credit card company. You can have $1 on a credit card as long as you pay it off after the statement date, but before the due date, so you don't have a late payment, and so that it reports. That has the exact same impact as actually it serves you better because your utilization ratio is lower, but that has the exact same impact as using the full 30%. There's just people that don't know that stuff, and they go out and they use credit cards thinking they have to, you know, put incidentals and stuff on there to get that 30%, but that's actually working against you. So if you want to build credit effectively, you have to understand what factors into that score. And that's the kind of stuff that we go over in like the lifetime, so that we get just a little bit deeper understanding into financial literacy, and we really optimize things a little bit, just a little bit more, right? But that's, I'm not trying to sell lifetime here. That's down the road, and that's kind of inaccessible for a lot of people. It's like, it's a lot. It's like 55,000, something like that. Not 55,000. Geez, I said that horribly. It's about a $5,000 product. We have $1,000 down payment and then payment system, blah, 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 blah. But this isn't, again, I'm not a sales guy. So start with free stuff. Grab yourself the free trial. Grab yourself that, go to that email page so you can catch Lee's live stream. And then if and when you're ready, he's got his coaching program. It's a hell of a lot cheaper than $5,000. And that will really help solidify that foundation and help you stop your bleeding. All you got to do is show up and harass him. He's fun. You get your own personal person that you can harass. I'm just kidding. He's going to hate me for saying that. But does the fib stuff hopefully make a little bit more sense today? I hope so. There are a lot of different ways you can use fibs, but this is the most common and the most, I would say, effective way. I think, unless you're really fine tuning and all that, but you're not going to mix this with other stuff until you learn the other stuff. So just in the spirit of gamification, on a scale of 1 to 10, 1 being I have no idea what the hell a fib is, 10 being I'm very confident in my ability to understand and use fibs. How would you guys rate your understanding of fibs at this point? And this is just 2 tools, by the way. Shin says, I will rewatch tonight, miss the first half. Sybil says 5 for me. Good, good. Yeah, I don't want to see a perfect 10. That would mean that you're either insanely intuitive or you're lying. That means I've done too good of a job, which I haven't. Arch Knight, well to graph. Yeah, just to draw it. Just to be able to use it and kind of understand what it's for. So somebody give me a ticker. Just any ticker. We'll practice some. NBTS. All right. That. My finger automatically tapped NVIDIA. That's funny. All right. So we are on. Let me just erase these drawings here because I've already maybe looked at this one. So we draw bottom to top, right? Guess where we're at? So now we're in the golden box, right? For those who are curious, by the way, 61.8%, that's called the golden mean or the golden ratio. It's just a number. Everyone's kind of got their own meaning behind the Fibonacci numbers. They do exist. It is a natural sequence that is pretty prominent. But in the stock market, it's a little bit real. It's a little bit voodoo, right? So don't blindly subscribe to that 61.8% level. But this one just happens to have hit that almost perfectly within 3 cents of it. So that's good. Now, what's missing here? Golden pocket, yeah. But there's something missing here, so we can't trade this yet, right? The breakout of the 50? Well, we've had a breakout, right? Price pushed down, right? It closed down here, and then it popped over here. You got a couple of wicks, right? But there's something that we're not seeing, which means that I can't trade this. What's my first priority as a trader? I mean, I could trade it. Know your target and your stop. Okay. And then more importantly, I need to make sure that risk is small, right? Can't lose big if I risk small. Okay. So what I don't have here is a tiny red candle that I can use to base my risk on. Let me just find an example. This right here. This is beautiful. This risk range is 5.71%, and that's still considered big, right? I can use a 1% rule and bring that 5.71% down to 1% or less, right? Is anyone here not familiar with the 1% rule? Let's put a 1 in the chat if you are, a 2 in the chat if you're not, just so I know. And then we can talk about that on another stream. Sybil is not. Oh, okay. Newbie is not. You guys got some learning to do. Okay. That's how you guys aren't in premium. Are you going to be around Tuesday morning? By chance? Yes. Okay. Newbie, how about you, buddy? At market open. Or better yet, are you going to be around Friday at like 11:30 Eastern? AM, not PM. Yes to both. Okay, perfect. Would you do me a favor and just remind me about the 1% rule, and if I don't remember it myself, and then we will definitely dig into that, because that is also a game changer. If I can if I can teach you a very simple way to make sure that all your losses are 1% of your portfolio or less, and that all your profits are about 2.5 to 3% overall, that would be a game changer, I think, for you, right? What's your most recent loss? How big was it? As a percentage, sorry. I don't need to know your portfolio size. Just percentage. 10%. Okay. You know what happens if you take 10 1% losses in a row? Let me pull up a spreadsheet for you. I'm going to show you guys a little bit of a magic trick. If you take 10 1% losses in a row, you only lose 9.5%. You want to know where the that extra 0.5% goes? It goes into the ether, right? It's just gone, right? It's a black hole. That's the magic of compound, right? It just disappears. It's just gone. Someone else just ate that. It doesn't make sense, right? It's the magic of math. So if you were to take 10 losses in a row of 1%, you would only lose 9.55% overall. If you lost 9 trades and won 1 at a 1 to 3 ratio, so 1% loss, 3% profit, you'd end up negative 5.90%. Okay. If you won 2 out of your 10 trades, you'd be down 2%, 2.1%. If you win 3 or more, you're net positive. It's starting to look a little more appealing. right? Have a 30% win rate and still outperform 90% of the market. I'm okay with that. Guess what happens if you win all 10 trades in a row? You would think you'd get 30% profit because you're taking 3% and you're adding it up 10 times, but you actually get 39.39%. You want to know where that extra 9.39% comes from? It's the ether, right? The ether, exactly, Tammy. Tammy gets it. She's been through this a lot. But that's an interesting little machine, right? And it doesn't take much to get that. Right? And this doesn't necessarily mean that you're only allowing 1% of risk. Because if we come back here and we say, okay, well, this risk is 5.71%, right? Let me just draw this out. Say this is your entry and this your stop loss and all that good stuff. And you're using a 1-to-3 ratio, right? We're somewhere around there. Okay. This is still a 5.71%. So what we do is we just adjust our position size to make sure that this loss is only 1% of our net worth. Okay. Our net portfolio value. And the profit, therefore, is still, it's limited, right? This is a 17% profit and it would have happened to have worked out. But if we use, 10% of our portfolio, that's only 1.71% in profit anyway. So why not just make that 3%, right? So we're almost doubling that potential profit. We're just bringing this into a more fair and more consistent balance. So if I take 10 trades in a row, I can have 10 defined potential outcomes. Okay. If I take 10% of my portfolio and put it here and take a 5.71% loss, maybe I do that twice. Then I take a 17% profit, and then maybe I take a 3.28% loss, and then a 17% profit, and then a 26% loss. Like, it's going to be all over the place. You're not going to get consistent numbers, and that's going to drag your emotions all over with it, right? So we can use something like the 1% rule to stabilize things. Okay, so again, that'll be a different conversation for another day. I don't want to go too far off into the weeds there. But this is another example of something that we can just bend the rules a little bit, because this is what the banks do. Now, what I'm not seeing here is this low risk opportunity. Okay. Now I have kind of one, right? It's kind of forming. I've got this kind of area here. It's 3.31%. I like that. But now I need a breakover. Okay. So what I can do is I could say, okay, well, Pookie, we're going to watch this one tomorrow. And this will be our entry and this will be our stop loss if we do get an entry. And then I need a 1-to-3 risk reward ratio. And that falls within the fib extension, right? Because again, we don't need that whole range. We just need a piece of it. Okay? We don't want to shoot for the stars all the time on every single trade. So I can then say, all right, Pookie, well, here's the deal. Okay. We can get rid of the fib drawing because it's messy. And we can draw our levels here and we can call this a target. Okay. And we can call this an entry. And we can call this a stop loss. And then we could say, okay, well, I'll keep an eye on it tomorrow. This goes on my watch list. It's one of maybe 4 stocks that I'm watching for tomorrow. Okay. Now I can also calculate out ahead of time what my position size would be because I understand the 1% rule and I know exactly what the risk range is. So I know I'd use about 1/3 of my account for this. Okay. So if I'm in a $1,000 account, I'd buy $300 worth of shares, which would get me about 28, 30 shares, just roughly estimating here. Right. And then that tells me exactly what my profit will be and exactly what my loss will be, because I know that if I'm on a $1,000 account, my loss is going to be $10 and my profit will be $30. I know that all ahead of time before tomorrow. So when tomorrow comes by, I can say, okay, well, the price pushed over my threshold and it went up and hit 828 and I locked my profit automatically because I was proactive and I placed a buy stop order with a bracket for take profit and stop loss. And I know exactly what I'm doing with those. So I have to work less, but I can still make profits. This is a side hustle, right? I don't want to put a lot of work into this. I could say, okay, I already know my profit on this trade will be $30 and my loss will be $10. One of those two is absolutely going to happen at some point. It's just a matter of being in position when it sets up, when it confirms, and when it tells me it's time to get out, I get out. And then that's all the effort that I have to commit to trading. And then it's just a matter of doing that a bunch of times. And then you get really bored And then you start looking for a more efficient strategy. But when you're new, your job is to focus on studying yourself and figuring out, well, I know this. I got my watch list built. I did all my charting. I did all this math and I calculated out my position size and I placed my buy stop order, but I didn't feel like setting a bracket, right? Or I see it went up, I moved my level, or I moved my stop loss down because I didn't want to get stopped out because of something from my childhood, right? There's always some justification somewhere about something that causes us to deviate. So our job is to figure out what causes us to deviate and then put specific barriers in place, because those deviations are what destroys our portfolio. That's your job. It's not to figure out which profits are going to blast the next day, or which tickers. It's not to figure out, the best way to get into a stock before it shoots up 250%. It's to focus on how you react to things. And the better you get at that, the better your progress will be in the market. Like Death Gun here, perfect example. He's using one consistent system and he's doing really well with it, but he's feeling like he's plateauing and maybe wasting a little bit of time because he's not seeing consistent green. And that's the perfectly normal and healthy part of the process. But he's also outperforming 90% of traders right now because he's not bleeding out all over the place. And he's going to be in the market a lot longer because he's on this trajectory. Where his losses are, whoop, that's too big. I hate my browser. Because if you look in the profit channel, you can see that his posts are all, like 1% or less on most days. Obviously, there's going to be some little hiccups here and there with the execution and stuff, but he's going to get something between these two numbers at the end of just about every single week. And there's 250 trading sessions in a year, which means that this number compounds stupidly fast and stupidly well. So even if right now he's currently taking a bunch of these little 1% losses, and I'm not trying to pick on you, he's going to have a much better time in the market than everyone around him. Plus, he's at a young age, and so many people here would kill to go back in time and start this at his age. But he's on the right track. He's on a healthy path. He's got the right mindset. He locked in we chatted for about 2 days. The dude gets it, and I love seeing it. So it doesn't matter where you're at. It just has to start somewhere. Yeah, I would kill to go back to. So jealous. I can't tell you what I was doing at that age, but it wasn't trading stocks. Oh, Tammy, you're not old. You're going to look back and say you were young. Sorry, let me catch up on the chat here. Shin says, I hear you talk about that 1% rule a lot. When I mentally follow that, I would be stopped out of every trade. So I assume that you're talking about 1% price range, right? Because if that's the case, I got you. Actually, I'm going to work on that tomorrow morning with you if you want. We'll talk about our momentum breakouts. So if I were to grab one from this morning, BRME. Oh God, it's so blocky. You didn't hear me? Oh, okay. That's trash. I don't like that one. Need something with some volume. There we go. Okay. So for you specifically, if you're referring to a price and then only having a 1% stop loss, we can do that. But what you're saying is that if you followed that, you'd be stopped out. So like this one right here, pushed up and then pulled back down, you would have stopped out. Pulled up and then it stopped out right here. Pulled up and then this one didn't stop out. It went, but that's okay. So that I assume is what you're talking about with the 1%. That's slightly different than the 1% rule itself with position sizing. So for this stuff, we're going to cover that again tomorrow morning in premium. And I'll teach you how to trade the momentum breakouts using the order book and range breaks and things like that so that you can keep those stupidly tight risks if that's what you want to do. Is that something you're interested in? Nova Spire, 0.43% stop loss today. Didn't read the news. Rated an offering. I mean, that happens. But you took a less than 0.5% loss. That's insane. Even Death Gun would be inspired. And he's got insanely small losses. $5. That's beautiful. Because I'll tell you what happens, right? You guys get a little bit of story time here. Let me make sure I have the social media comments up as well, because I don't want to neglect anybody out there that's interested in this stuff. So what happens? I had to make sure I was live. Oof, that's awkward. So people stay in the market for a long time, a lot of times, right? You get like almost an immediate decision whether or not you're going to be in the market for a long time or a very short time, right? And it usually boils down to your first 10 trades. If you trade 10 times in a row, the likelihood of you staying in the market for a while, like more than a year, is usually pretty high. If you bail after like trade 3, the likelihood of you coming back to the market's pretty low. And you never made it to trade 4. And that's okay, right? You just have either a misunderstanding of how the market can be used, or you just have a very low risk tolerance and prefer to put your money in other avenues. And that's okay too. There's no wrong answers with this stuff. But the people that stick around for a while, they tend to strategy hop for a very long time, meaning they just chase that unicorn strategy that's going to be right all the time. And that's just denial. You're denying that losses happen. You're trying to make sure that they don't hurt you. And instead of finding a strategy that minimizes losses, they focus on strategies that are typically right. Okay. You could be right 100 times in a row. If you're wrong the 101st time and that's what destroys you, that strategy is completely useless. And that's where people mess themselves up. It's because when they're wrong, they get messed up. Okay. So what people do is eventually they usually reach out to Pookie or to Lee or to Bull or to Duck or to Nikki or one of the people that's been doing this for a while. And they say, hey, I need help. Like, what is going on? And then I say, well, tell me about your last loss. What happened? Right. And it's always this big dramatic loss in a lot of cases. I can't say always. I hate absolutes. So sorry about that. It's usually some big epic loss that lost them 40% or 60% of their money, because that's what prompts them to reach out and ask for help. Right. It's that moment of despair where they realize that they have to make it back and that it's not easy and they need help. Right. So rather than going through all that, the very next question that I ask is, where would you be at today if you were able to go through your portfolio, all your losses, and add them all up and take all the ones that were over a certain size and take that specific chunk of money and put it back in your portfolio? Where would you be at? And it's always a gut punch, right? Because there's a lot of those big losses and they just keep depositing paycheck after paycheck after paycheck and ignoring them because of that cycle of denial. So our job early on as newer traders is to break that cycle as fast as possible. Okay. You have to get out of the mindset that losses won't affect you and that they don't happen and that they can be avoided. And instead you have to embrace them. They are literally your best friend. If you can take a loss and you can make that loss very, very small, what you've done is given yourself something that 90% of traders fail to give themselves, and that is opportunity. Okay. So if your strategy relies on just grabbing small red candles that you can find over and over and over again and making sure that the risks that you take are controlled and measured and that there's disproportionate upside potential, right? High potential, low risk. You should have a decent time in the market overall, right? But it can't be reduced down to any one trade. So when I ask and I say, hey, tell me about your last loss, I want it to be the same as your 30th loss. It should be the same size or less, right? And we can definitely just build strategies that do that, but that's not where people start. And that's what makes my job difficult, is because I have to get through and destroy that mindset of I need big profits so that I can replace that with I need small losses. Okay, so that's the mindset that I want everybody to adopt. It just takes a lot of time. And sometimes people they need to run into that wall before they're willing to accept it. And that's what hurts. So when you guys ask me questions, I'm just talking to a past version of myself. That's all it ever is. I didn't have someone to sit me down and say, hey, stop focusing on profits and start focusing on your losses. And if I did, I'd be a lot farther ahead than where I currently am. And I'm currently in a decent spot, you know, like been doing this for a little bit. But that everyone's different. We're all on different parts of the same journey. Okay. So if you took a 0.43% loss, I want to see nothing but smiley faces, because I want you to praise yourself, because that is insane risk management and I love it. Sorry, I'm just kind of scrolling around here trying to find some examples. Here's a decent example of a fib retrace that happened to work out. Right now, this one's a little bit deeper. You can see that it did go below the 61.8. It did go higher, and then it came right back down. Right. So if we're looking at this chart, first off, this is garbage. You see all these like wicks and gaps. This is just garbage. When there's big chunks missing between the candles, like the closing price and opening price, that's unreliable data. You have to move up or down in time frames to get to something a little bit more readable. And even that's pretty garbage. And the volume is just super low. So this chart just sucks. See, there's no volume on this. But if we were to read this, I'd probably start with at least the 3 minute. And then let's just skim across this line, just like pretend it's the surface of the water. Ignore everything below it. Just see if there's a little red candle sitting on here like a little lily pad. There's not. Okay. So there's nothing we can really do with that specific strategy. You can skim down here and do the same to the red 61.8. Here we've got one. Right. So it's a relatively small risk. Now this wick here and this wick here makes it unacceptable. So we can't use that. And this candle didn't break over. So that wouldn't have been an entry, which means this low happened, which extends that range before the price is broken over. So it's just too unacceptable of a risk. So that keeps us out of the trade, and that's our job, right? Our job is not to get in with the hopes of making a bunch of profit. It's to find reasons to stop trading and to get out of stuff. That's the mindset we have to adopt. So let me just kick back here to the 1 minute. This is absolute trash. Huh. All right, that's pretty cool. Now, another super simple strat. I'm just going to give you guys this one as a little extra here. Find any high and any low, right? Just any high and any low. And ideally, this range is nice and small. Like I could probably make it even smaller by using this low right here, just kind of working backwards. So let me just do that. And then I got this high right here, so I can make this a little bit tighter. You guys know what I just did? You know what that action of moving those lines closer together is? I reduce my risk, right? So it doesn't matter what pivots you start with. If you just want to find where price turns around and draw a line and then move them closer and closer each time the price moves around, eventually it's going to break out. It's going to go up or down, right? From that zone. And all you're doing is just finding reasons to look for a breakout. So in this case, the price broke out, and then it would have stopped out here. And then the price broke out here. You might have stopped out on the same candle, or maybe this one here. And then guess what? It broke out again. Okay. So guess what happens if we take 3 trades and we win one of them with a 1-to-3 ratio? Let's find out. 100%, or sorry, $100. Okay. Minus 1%, minus 1%, plus 3%. We're net positive, right? So what happens if we do that 250 times? That's there's so much power in just not looking at super wide moves and really just focusing down on super small, simple concepts like that. You're going to have a much better time in the market if you make things less complicated for yourself, because it feels good to do a lot of work. And we're conditioned to believe that, if we put in more work, we get more reward outside the market, because that's how we grow up. But in the market, it's the exact opposite. You want to do less. Okay. Then I got a range up here I can use, right? So I got a high and a low. So let me just move some lines. And then let's see. I don't really like to push them close together when I've got multiple wicks like that, because if we're watching this as it forms, right? This one counts. Yeah, let's move this down. And then let's see. Does this one validate? That validates. So I'm just going to move that closer. And then we get a breakout here to the upside. And now I am looking at this kind of the top runners list, so you have to be careful there with confirmation bias. But you can see very clearly here that the price did in fact break up to the upside. And what I personally like, and again, this is low volume, so ignore it. But just look at the compression of price right there. You can see this area is visited multiple times and it just kind of hangs out. This is where I look for those displacements. So I've got another area right up here where the price just kind of clusters. And then that's the kind of move that I personally like to look for. And it typically goes back and forth between those zones like that. So here's another area where the price just kind of finds support, if you will. And then here's another area right here. And you can just watch the price go back and forth. Now, again, this is a garbage time frame here. There's just no volume, but you guys get the idea, right? So just go back in time and practice it like a lot. So with that said, though, I do got to jump off here. I didn't want this to be a super long one. I just kind of wanted to walk you guys through the fib stuff. Does that make sense? And do you guys see that there's really no huge advantage in using any one specific strategy other than the one that you can use? And then on top of technical analysis, right, which is only 5% of trading, it shouldn't be complicated and it shouldn't be most of your effort. 90% of it's psychology, 5% is analysis, 5% is execution. So aside from technical analysis, which is looking at charts and plotting levels and doing all the fun stuff, there's position management, right? There's position sizing and position management. Those are the next levels of risk hierarchy. And those always take precedence. They're more impactful than the analysis itself and the amount of risk that you allow, right? So, you know, I'm not going to go through the whole risk hierarchy today. I'll do that on the next free live stream. But just understand that technical analysis is not the end all be all of your success in the market. It is how much you risk and how much you are willing to accept as a loss over a set of trades, okay? Profits will happen. Profits happen to everybody. You know, most of the people that I talked to that have these huge losses also had huge profits. It's just a matter of asking yourself why the hell you're allowing those losses and then realizing how silly it is, but you just don't know any better. And it's perfectly normal as a human to just not know what you don't know and to allow yourself to kind of be subjected to that. You just don't know any better. But going forward, right, you can always make that choice to say, okay, I'm no longer willing to tolerate this. So I'm going to cut my loss right here and have confidence in that and praise yourself. And that's where, you know, we get into like the pennies and things like that, which is a separate conversation. Okay. Sybil says, absolutely makes sense. Okay, good stuff. Novaspire, again, you are inspiring me and Death Gun. You made a 0.43% loss for the day. That's awesome. And that was during an offering. So good stuff, man. So with that said, though, I'm going to cut off the live stream on social medias. I will hang out with you guys here in a second. Un momento.